Hi, welcome back. On today's program, we're going to discuss mutual funds and index funds and which of the two you may consider purchasing. Now, index funds are also known as ETFs or exchange traded funds, but there are differences between the two, things that you want to think about before you decide that you're going to buy a mutual fund or an index fund. So we'll get into that in just a moment. Hi, I'm Gerald Marquith. I'm a certified financial planner. This channel is intended for those 50 and under. We're going to discuss things that they should have taught you in high school and college, but well, they never did. So let's kind of get into this subject because there's quite a bit actually to cover. So you've decided that you're not much of a stock picker. You don't know much about whether you should buy or sell. It's a lot of work and quite frankly, a lot of risk. Stocks can go up and down 5, 10% at one given time, even in a day. And so you don't want the volatility. So you decide, I need professional help. And that's exactly what mutual funds and to some extent index funds can offer you as an investor. And keep in mind, while we're going to be talking about stock funds, there's such things as bond funds as well for fixed income. But we're not going to discuss fixed income in today's video. Let's talk a little bit about how these two different products, active mutual funds and index funds, work, because that's important for you to understand the mechanics of it so you can kind of determine what's the right course of action for you. So let's talk a little bit first of how does a mutual fund actually work. And mutual funds have some interesting qualities to them that you may or may want to consider. So if we look here at the chart that we've set up, we see here that mutual funds start with a pool of money, investor money, not just yours, but other monies from many investors, and they take that money and they will go and buy securities with it. Like I said, we're talking right at the moment about stock or equity funds, but just as easily we could be talking about bond funds. So they take the investor money and then they in turn are going to begin to invest that into a portfolio of other things. Keep in mind here that these are actively managed. Day to day, they're buying and selling different stocks and trying, of course, to do the best for you. They're trying ultimately to beat index funds. So let's say you have a mutual fund company and they're trying to beat the S&P 500, which is the top 500 companies in America. So that's what they're attempting to do. That's not easy, by the way, as we're going to see in looking at this. So if we look at the characteristics here, it's actively managed. They have professionals. They usually have a team of researchers on staff to decide what stocks to put into the portfolio. Their fees can be high compared to index funds, and we'll make that comparison in a little while. But if you think about it, their aim is to beat the averages. Now, they do have professionals doing this, and they're trying to research the best companies to buy. And that might even be daily. We call that turnover. If they're constantly buying and selling, that's called turnover. You can find their turnover percentage if you go online and look under the symbol of the mutual fund company. They'll tell you what percentage of their stocks get turned over in, say, in the course of a year. So they take that money then that they bought and sold, and they put that to work for you, and they have a portfolio then of stocks. And of course, your return is highly dependent on how well that portfolio overall does. Now, keep in mind, they are collecting what's called an operating expense ratio, OER, and they're getting paid that way. So you're paying them for the mutual fund itself. That doesn't mean you get a bill separately. It's actually inside the mutual fund itself. So to give you an example, say your mutual fund made 10% and say their expense ratio was 0.5%. Well, you really, as the investor, are going to make 9.5% on that money. That may not be bad, but just keep in mind that you're not getting the total return. because obviously you have to pay for the money managers and the researchers and the overhead, all those things that go into it. Plus, of course, the transactions they do. You're paying for all of that, and you're looking for them to, as the statement goes, beat the market, which in this case means beating the index itself. So now let's switch gears for just a moment and look at how exchange traded funds work. Now, those are also known as index funds. In this case, it's slightly different. They have a basket of stocks or maybe bonds. They create new shares, and then they track an index. So if it's a tracking, say again, the S&P 500, what it's going to do is buy basically the top 500 companies in the index and just hold them. There may be occasional times they have to sell them or add or subtract a new stock in the portfolio. But basically, this is very passive. They're not doing active trading. They're just basically buying and holding what is in that index. And of course, as you might imagine, the cost of running a fund like that is very, very low, sometimes like 0.03%. We're talking a very low amount, honestly, because it's very passive. There isn't much in the way of overhead to spread out to you. Now, they're also very transparent. In other words, you could go in and see their portfolio and they'll show you all the stocks they own. Now, in the case of a mutual fund, it's a little different. Every 3 months, they have to show you a list of what they hold in the portfolio. However, on a day-to-day basis, you don't know exactly what your mutual fund is holding. It's all hidden away. And that's done for competitive reasons. They don't want a competitor to figure out what stocks they're buying that may be of interest to them also. So again, this is a diversified index. And the idea here is that you hold on to it. When it comes here to something now, we're going to switch gears again, looking at the key differences between the two of them, you'll see that the management style is different. One is really, it's just passive. Think of them basically just sitting at their desk and not really doing a whole lot, if you want to look at it that way. And likewise, in the case of a mutual fund, it's actively managed. In other words, they could be every day buying or selling a particular security in it. Now, the trading ends on a mutual fund at the end of the day, where they provide you a net asset value. They tell you, here's the price of our mutual fund at the end of the day. What they add up all the stocks and all the investments we made. This is what your share of the mutual fund is. In the case of index funds or ETFs, they trade all during the day. You can buy or sell an index fund during the day at any given moment in time. You can buy it or sell it. Now that can be an advantage if, let's say, the market were, let's say, crashing, going down a lot, and you wanted to get out of the market. Well, you could easily go online and sell your ETF. Not so with a mutual fund. You can sell your mutual fund by a certain deadline, generally between 2 p.m. and 4 p.m. Eastern time, but you're not actually going to get sold out until the end of the day, and you have no idea what the market will be by the end of the day. Minimum investments are usually fairly low. Some mutual funds may only have you invest $1 in it. Others want a minimum investment price. Usually, in the case of index funds, 1 share is obviously the price. Now, when it comes to tax efficiency, this is important to know. So index funds are tax efficient. In other words, they're just holding the securities in there. There's not a lot of buying and selling going on. But in the case of a mutual fund, they may be buying and selling, and let's say they're selling some securities at a profit and then buying others. Well, at the end of the year, you may well get a statement of capital gains that they made in there, which, by the way, capital gains are taxable as well. So index funds minimize that sort of thing, whereas, of course, in actively managed mutual funds, well, it's a little different. So I used to get asked this question quite a bit. How is it that when the market is up, let's say the S&P 500 were up 2% in a day, how come when I look at my mutual funds, my active mutual funds, I'm actually flatter down? And the answer to that question is that they are constantly changing the portfolio. So you don't know what was in there, and the choices they made caused the fund to stay, say, flat or maybe even down. And so it doesn't match up. Again, they're trying to certainly beat the market, as it were. And of course, you invested with that idea that they could do better than just an index fund. Now, John Bogle, in one of his books, which is about common sense in mutual fund investing, makes the point that this is very difficult. Somewhere between 80 to 90% of mutual funds cannot beat their indexes on an annual basis. Now, some have had really good track records, don't get me wrong. Some have actually beaten the market over consecutive years. Again, that's a rarity. That's not necessarily something you're going to see all the time. And the challenge for you as an investor, especially if you go into a mutual fund, is you don't know if this money manager you're hiring in the mutual fund is actually going to beat the market. So those are things that you want to think about really strongly. Do I want to get into a mutual fund where hopefully they'll do better than what the market is doing? Or do I want to be in an index fund and just take whatever the market is giving me? Those are questions for you to answer. Now, keep in mind here that when we're talking about these particular investments, keep in mind that not all of them are going to do well. I mean, some mutual funds will do just fine, and others, well, they'll lag. Now, the money managers of mutual funds are fully aware of this. They want, of course, the portfolios to do better, because obviously, if they're not doing well, you know what you're going to do. You're going to sell out of it. Many times, you'll see in magazines at the end of the year, top 10 mutual funds to buy that have done really well. And sure enough, they have. But there's no guarantee that next year they're going to have the same return. In fact, some mutual funds reverse course after having an outstanding year. Likewise, some mutual funds are very, very active and very volatile. So you want to be aware of that. It'll swing all over the place. And as we talked about, not very transparent. You're not really sure what they have in the portfolio and what's causing it to go up or down. Now, when you're considering this in the case of mutual funds versus index funds, you want to also consider that you want to be in this for a longer period of time. You could treat a mutual fund, or even an index fund for that matter, almost like an individual security. You can say, I'm going to buy and sell it. If it goes up here, I'm going to sell it. If it goes down there, I'm going to buy it. But I would say in these particular investments, it's more for long-term holding. You can certainly add to the portfolios that you have. That's also known as dollar cost averaging. And so if you have, say, $100 a month going into a mutual fund, you're going to get a range of prices over the year, or in other words, an average price of what you bought into. Now, mutual funds are not bad. Certainly, they provide a great service to you. You have professionals managing the money, which you already admitted that you're not going to be professionally managing your own account because you have no idea maybe what you're doing. And in the case of index funds, you might say, well, that's kind of boring. I'm just going to get what the averages are. But keep in mind, and again, we'll use the S&P 500 as an example, over long periods of time, index funds for the S&P 500 have averaged about 10% a year. Now, you don't get 10% every single year, but you can, on the long term, it appears, do fairly well. Again, your decision that you have to make is whether or not mutual funds are right for you or whether index funds are. Now, it really is a concern if you're constantly looking at your portfolio. If you're constantly looking, the temptation is, of course, that you'll make a bad decision and sell at the wrong time. In fact, they've done studies on this, that the more often you look at your portfolio or your mutual fund or your index fund, the more likely it is that you'll make an emotional decision and you will not benefit the way you had hoped. This is also true if you're individually investing in stocks. You can see something happening in the news and you immediately say, I've got to get out of it, and then find out that it wasn't quite what you thought, and the stock or the mutual fund goes straight back up to where they were. This is challenging for all investors, but it certainly takes peace of mind. It gives you peace of mind what you're doing because they're managing the money. The money managers has it there. The index fund is just tracking a basket of stocks. And so you know that someone is watching the portfolio. You can't do that every day, maybe because you're at work all the time. So there is advantages to paying for these services. Again, you're going to pay more for an active managed mutual fund than you are an index fund. But you have to decide what's in your best interest to do it. Now, Mr. Bogle's book on common sense in investing with mutual funds makes the point that there's what they call investment friction. And what he means by that is that the fees can be quite high. And so you want to look very closely at what kind of fees are being charged in the mutual fund, because you're ultimately paying for that in your return. That friction, as he describes it, can hold back the amount of return you're going to get. Index funds, not so much. Index funds are fairly close to what you're paying for. And so in the sense of a return, an index fund will give you close to what they're actually making, whereas a mutual fund may or may not. So you might want to drop a comment in there about what you think about this between actively managed funds and index funds, what the best choices might be. Now, I'm not going to recommend any particular index to you or any particular stock mutual fund. That's for something that you can research on your own and decide what's in your best interest. But keep in mind that millions of people do this, and they do it over a long period of time. Are you going to become a multi-millionaire doing this? Well, I guess if you gave it 30, 40 years, maybe. But it's not like an individual stock, which is able to double or triple even in 1 year if you happen to get the right stock. Or as we pointed out in a previous video, if you had invested like one person did in NVIDIA and held it for 8 years and ended up being a millionaire. That's all very possible with individual securities. But again, more risk, more responsibility on you, and certainly it has a part of emotions that go into this as well. So I hope you found the video helpful. I'd like you to like and subscribe to this channel and leave some comments in there about what we've discussed here, whether you would choose an active mutual fund versus a passive index fund for your investment strategy. I look forward to seeing you in our next video, and I hope you have a great rest of your day. Take care.